Good morning. My name is Morgan Garvey, and I'm in the Development Department at Rice University's Baker Institute for Public Policy. Thanks for joining us today, and thank you for being a member of the Roundtable or the Roundtable Young Professionals. We're glad you're here. We have Jorge Barro, PhD, with us today. He is a fellow in public finance at the Baker Institute. His area of research involves the development of dynamic macroeconomic models for fiscal policy evaluation. His specific research areas include corporate tax policy, state and local taxation, and the design of federal healthcare financing. Dr. Barro has a PhD in economics, and today he will discuss the consequences of long-term government debt growth on the economy. We look forward to your questions. You can ask them through the Q&A function at the bottom of your screen. I will ask your questions for you at the end of Dr. Barro's presentation, and we will get to as many questions as we can in the hour. With that, I'll hand it over to you, Dr. Barro.
All right. Thank you so much, Morgan. Let's see. Let's get this pulled up. All right. Well, thanks everybody for tuning in. Today I'll be talking about a topic titled U.S. Government Debt Growth in a Time of Secular Stagnation. So you're probably familiar with kind of what's happening with U.S. government debt. It's obviously been significantly increasing. There were a number of things that have happened over the last 10 years, including the Great Recession. I guess that's probably a little bit more than 10 years by now. But we've also had tax cuts, that were coming up on 3 years ago, and a new kind of event that's happened that has also caused a surge in U.S. government debt. So this COVID-19 pandemic and the corresponding fiscal response has sort of prompted the government to pass a number of pieces of legislation that have increased U.S. government debt. So there's obviously this big concern that it becomes an issue, and that's sort of the question we're addressing today. What you may not have heard of is this concept of secular stagnation. So this just refers to a number of things that we're seeing right now and things that we've seen in these macroeconomic trends over the last 40 years or so. And so I'll talk a little bit in detail about what this secular stagnation thing is and why it matters for the purpose of understanding the impact of U.S. government debt growth. Okay, so we'll get a little bit of bad news out of the way. This graph shows historical U.S. debt as a share of the economy. So that's the blue area, and the red area is the projection provided by the Congressional Budget Office. So right now we're at about 80% of GDP. So this is still below the historic high. So the historic high is about 106% following World War II. And that it steadily declined after World War II. It rose a little bit in the 1980s, and then it fell back down throughout the 2000s. Then we hit the financial crisis. It shot up. We have had a number of tax cuts, and of course this projection was provided before the COVID-19 pandemic. So again, right now we're at about 80%. I think that this is probably going to be at about 90% GDP, within the next few months. But the more kind of alarming thing is that this is expected to rise to about maybe 190% of the economy over the next 30 years. So the obvious question is, is this a problem? Is it something we should be worried about? It seems like we should be worried about it, but as one of our young roundtable members suggested, that Americans are kind of suffering from a little bit of debt fatigue. We've been told for so long that debt is an issue, that it would have these harmful macroeconomic consequences, but we kind of just look around and we don't really see them. So at what point should we start caring about government debt? Why isn't government debt having the big bad problems that we've been warned about for ages? And you know, what can we look for in the economy to determine whether or not increasing government debt is going to continue being an issue? So those are the kinds of issues that we'll be talking about today. Okay, so why is government debt increasing? So as it turns out, the revenue as a share of the economy is not projected to decline. It's relatively stable despite the tax cuts. But the main drivers of debt growth are actually on the spending side. So the CBO breaks it down into three different categories. The first is the aging of the population. So this is something we'll spend a lot of time talking about today, the consequences of an aging population in terms of macroeconomics and in terms of government debt growth. As it turns out, these two things are pretty closely related. So the aging of the population and the impact that it has on government expenditures can mostly be accounted for by Social Security and Medicare. So we have a lot of people that are going to be reaching retirement age with the sort of ongoing retirement of the baby boom generation. That's going to certainly increase expenditures as we have to finance Social Security for these cohorts, and Medicare as well. So as soon as they enter into retirement, as soon as they reach retirement age, they can enter into Medicare, and so these are going to be represent significant increases in U.S. federal outlays. So the second issue is rising healthcare costs per beneficiary. So in addition to financing the health expenditures of a large number of new people, the federal government is also facing rising healthcare costs just the same way that anybody on private health care is facing. And so that's going to be another big issue. And then finally, as the stock of U.S. debt rises, interest payments rise as well. So we'll talk about that, and we'll talk about some of the consequences of rising interest payments. Okay, so in order to understand, what kind of an impact debt growth might have, we just need to talk a little bit about capital market theory. And I won't get into it too much. Just kind of a primer on capital market theory, so that we have some way of thinking about, these different factors in the market that could be influencing the impact that government debt has on our economy. So then we'll take a look at some of the data and see whether the things that we predict from economic theory are supported by the things that we're seeing in the macroeconomy and the trends that we've seen over the last several years. So we'll talk about some of the conclusions that we can draw from the data, and then we'll talk about the future. We'll talk about what consequences these capital market factors have on the broader economy, and what can we expect to see maybe over the next 30 or 40 years. Okay, so just like any other economic market, it's capital markets are driven by a supply and demand process. So we usually think of households as supplying capital. And when I'm talking about capital, I'm talking about financial resources. You can think of, when we save, we don't just put it in the bank and sort of keep it there. This is the story that we've been told since we were kids, right? You put your money in the bank and it doesn't just sit in the vault. It goes in there and it's loaned out to maybe small firms or other households that want to borrow. But the general relationship between household savings and the interest rate is that when the interest rate rises, households tend to save a lot more. And it's the opposite for the demand side. So who demands capital? Well, it's firms that are trying to make investments. It's governments that are trying to finance their expenditures, and households that are also trying to finance certain things, like if you buy a house, you want a mortgage. If you buy a car, you generally need a loan for that as well. So the relationship is the opposite for the demand side. So the higher the interest rate, the less capital demanded. And of course, where these two things intersect is how interest rates are determined. So we usually think of interest rates as being the price in capital markets. So the big question is, how does government debt influence? How does it influence the capital market, and how does government activity affect the interest rate? Well, so think for a second about what happens when the Treasury has to issue new debt. So this is represented by an increase in demand, and it generally is going to put upward pressure on the interest rate. So when the Treasury Secretary has to sell new debt, usually they contact financial institutions, maybe other countries, and just generally find other buyers for the debt. And so when they have to do that, they have to compete with other people trying to borrow. So for example, when you get a mortgage or get a car loan, or when private sector businesses try to get borrowing for their investment, they also look for lenders. So this competition between private borrowers and the government tends to drive up the interest rate, as economic theory would suggest. The impact that government debt has on the private sector is that it tends to crowd out private sector activity. And the reason is because we said just a few minutes ago that when the government issues new debt, so it tends to drive up the interest rate, and for the private sector, this would decrease the demand for capital. So we get this sort of, maybe adverse outcome where an increase in government debt crowds out private sector activity, and it's because it puts upward pressure on the interest rate. Okay, so I showed you a graph a few minutes ago, basically highlighting government debt growth over the last several years. So economic theory would suggest that with large debt growth should come significant increases in the interest rate. So let's take a look at what interest rates have looked like over the last 40 years. All right, maybe a little bit unexpected, right? So this is the 10-year Treasury note with inflation taken out. So we call that the real interest rate. This is the interest rate that we actually expect to be influenced by market activity. Okay, so a little bit surprising. I mean, it was very low in the early 80s, probably driven by extremely high inflation. But since then, since the mid 80s all the way to today, the real interest rate has persistently declined. Okay, so even if you look at recent times, it even continues to decline. So the question is, why has this decline in interest rates happened at the same time as the government has been increasing, government debt at these monumental rates? So there's one possibility. Well, the sort of cheap response is that everything that we know about economics is wrong, but we don't want to go down that route. The second possibility is that there's more to the story, that there's more. That there are other factors that might be influencing capital markets in a way that may be overcoming any change in government debt. Okay, so I'm going to claim that the demographics play a huge role in what we're seeing today in our economy in a number of different ways. So I'll kind of review what's happened over the last 100 years or so, and kind of walk you through the logic of the impact that it's having on capital markets. Okay, so this is the demographic story. The top graph shows the birth rate since the early 1900s. You see a fairly steep decline over this 100 years. This bump in the middle is the baby boom, and just the bottom line is that it's very low now relative to what it was historically, and frankly, it's expected to continue declining. So a sharp decline in the birth rate At the same time, we've seen a sharp increase in life expectancy. This might be due to, better health decisions or maybe fewer wars. You can see right there this bottom graph, the impact that World War I had on the life expectancy. So this represents kind of a significant increase in life expectancy. So the big result is that both of these factors contribute to an aging of the population, a relative aging. So there's a decline in the birth rate, reduces the number of younger people, and an increase in life expectancy, shifts. It allows people to live longer lives. This is great. It puts sort of rightward pressure in the age distribution. So this is exactly what we see. So they say a picture is worth 1,000 words. Hopefully this animated picture is worth even more than that. So this is the change in, or the age distribution since 1900s. Since 1900. So a clear rightward shift, a decline in the birth rate, an increase in life expectancy clearly pushes this age distribution to the right. It skews it to the older population, and that's kind of the story of U.S. demographics, both historically and if you paid attention to this graph long enough, it would make projections out to 2060. So not only has there been a persistent increase in the average age, but also that it'll continue in that direction for the foreseeable future. Okay, so what impact is this having on capital markets? So this graph is what economists would call a life cycle savings profile. It is kind of a theoretical representation, and it's empirically supported, but it shows basically what happens over a typical person's lifetime. So we start life off where our assets are usually pretty low. Maybe we're borrowing to finance education. Maybe at 20 years old, we have a net worth that's pretty low. As we age, we begin saving. As we reach 30s, 40s, 50s, we're building up our stock of wealth. We reach our 60s and 70s. We get close to retirement, and then finally we retire and we start drawing down our assets, and this tends to decline over time. Okay, so think about the implications of a large number of people who are maybe 30 to 40 years old, as we might have had maybe in the early to mid 1900s. And think about the implications of an upward shift in the age distribution. So if we start having basically a large share of our population between 50 and 70 or so, then you might expect that savings in the economy is actually growing, right? So we get this kind of surprising outcome that because we hear so many times that Americans aren't saving enough, and actually, maybe it's true in a distributional sense. Maybe there are, we all feel like we could be doing better in terms of savings, but in the aggregate, what I'll show in a minute is that U.S. savings has actually been significantly increasing over time. Okay, so the data shows an aging of the population. That's sort of this this demographic story. We have a theoretical story that corresponds to economics that says that we have a lot more people that are closer to their peak of lifetime wealth. So the question is this supported by the data? Okay, so if we wanted to show an increase in savings over time, there's not a perfect measure of total household savings in the economy. That kind of the best thing that we have is a measure of, of net worth to GDP. So the Federal Reserve keeps track of this value. And so we look at what it was in the 1980s. So this was around 3.5 times the economy. And since then, it's surged to more than 5 times the size of the economy. Okay, obviously there was the sharp dip corresponding to the financial crisis, and since then, it's had this sort of monumental increase. Okay, so when we think about this in the context of compared to government debt, so we can start kind of thinking about the question of whether government debt is an issue or not. So the projection of government debt suggests that it's going to increase over the next 30 years by, about 1 times the economy. So is that an issue? Well, we look at this graph and we see household net worth increase from about 4 times the economy to about 5 times the economy just over the last 10 years. And of course, it was convenient that I picked the trough of this downward cycle in net worth, but it starts to put it in perspective. And actually, if we look at government debt as a share of net worth, this value has actually slightly declined recently. So household net worth has actually been rising faster than government debt, and I know that a lot of foreign governments hold a lot of U.S. debt, but 70% of it is still held domestically. Households still hold a huge share of government debt, and so should we be concerned about it? Well, capital market theory will maybe dictate exactly what's happening. So we can readdress this issue of rising government debt and the implications for capital markets. So this purple line shows the increase in government debt and the impact that it would have on interest rates. And it's not that government debt isn't putting upward pressure on the interest rate. It's just that aggregate household savings has increased so much that it's actually the net result has been a significant downward trend in the interest rate that has coincided with this big demographic shift in the United States. Okay, so to kind of summarize these things, we've had this big demographic driven increase in savings that's put downward pressure on interest rates. This macroeconomic phenomenon we would title the secular stagnation hypothesis or secular stagnation theory, and it suggests not that debt can continue growing indefinitely, but at least at the levels that it has been growing, that it may not be as big of a problem, at least in the short term, or until debt grows to some monumentally large number. And so we can actually look around to other OECD countries and see a very similar story. So if you look at some of the Asian countries like Japan or some of the Western European countries, they're all experiencing this same demographic trend, a general aging in the population, a decline in the birth rate, an increase in life expectancy, a rightward shift in the age distribution, a relative increase in savings. Part of this is what was dubbed the global savings glut, and it to a large extent can explain this downward trajectory in interest rates, not only in the U.S. but also across the world. So if you were to look at interest rates in other countries, you would see a very similar story. Okay, so we have these big demographic changes happening, and we have these economic models that anticipate to some extent, what's happening in terms of savings, in terms of interest rates, and in terms of potentially other factors like economic growth. And so what you might be wondering is whether or not economists can take these demographic changes, put them into an economic model, and create projections for the future. And as it turns out, that's exactly what we've been working on here at the Baker Institute, and a number of other scholars have also been working on this exact same issue. So we can put these factors, these demographic factors, into a standard macroeconomic model and actually replicate what's been happening over the last 40 years. Okay, so the demographic projections, the current demographic projections provided by the Social Security Administration and the Census Bureau suggest that that the birth rate is going to continue to decline, that life expectancy is going to continue to improve. And so we can take this data, put it into a simulation model, and show that savings is actually going to continue to increase. The corresponding outcome is that so long as government debt doesn't just shoot through the roof, we can expect that the interest rates will continue to decline over the foreseeable future. And it turns out the same is true for economic growth. So I was able to put these demographic changes into a standard economic growth model. And as it turns out, we can explain most of GDP growth. And now, I mean, trend GDP growth, I don't mean the cycles that we experience along the way, but the overall trend is something that we can account for to a large extent by demographic changes. So we've seen a pretty steady decline in the real interest rate, in the real GDP rate, from 3, 4, 5% in the early 80s down to about maybe 2, 3% recently. And as it turns out, the economic model would anticipate that economic growth is likely to continue to decline. Now, I don't mean to say anything that sheds a bad light on this, because the reality is that economic growth is an aggregate variable, but economic growth per capita is something that we can be more concerned about. So we're more interested in the impact on growth per person and the implications of policies on growth per person. So although economic growth, based on our projections, is expected to continue declining over time and stabilize maybe at around 2%, the reality is that the policies that we care about are the ones that improve economic growth per person. So I ran experiments with different variable changes like economic policy, like tax policy, for example. Tax policy had kind of a muted effect on economic growth. Not that it didn't have any effect, but and everything went in the direction that you would expect, but that it's not one of the major drivers of the growth rate of the economy. Population changes are. So that has implications for certain things like immigration. So if we really wanted to have kind of a large impact on economic growth, we could look at different variables like immigration, the immigration rate, skilled immigration rate, and certainly that could have an impact on government debt as well. But turning our attention back to government debt, there's this concerning projection provided by the CBO. Debt is expected to grow substantially over the next 30 years. And so we can ask the question, when will Americans finally care about government debt? So this is my best guess as to what will be the straw that breaks the camel's back. So we can look back and see at what points in history have we taken serious fiscal austerity measures to stabilize government debt growth. So in the aftermath of World War II, debt spiked. So this graph is showing interest payments as a share of GDP. The federal government took aggressive actions to reduce the stock of debt following World War II. We had significant economic growth throughout the 50s and 60s and 70s. In the 80s, we had extremely high interest rates that caused the stock of debt or that caused interest payments as a share of the economy to skyrocket. And so this put a lot of pressure on, I would say it's the George H.W. Bush administration to take action. They did. There was fiscal austerity at that time as well. There was a significant decline in interest payments as a share of GDP. At the same time, we saw significant economic growth that sort of reduced interest payments as a share of the economy. The economy grew, so this value declined as well. But notice that it hit its historic peak at about 3% of GDP. So 3% of GDP is might sound small, but it's actually a huge amount. If you look at where we are right now, we're lucky to be at about 1.8% of GDP. So one of the most surprising things that I think about a lot is the fact that debt is twice as large as it is when relative to what it was when these fiscal austerity measures were taken in the early 90s. So despite that, interest payments as a share of GDP are roughly half of what they were back then. So debt is twice as big, interest payments are half as large as they were back then. That can almost exclusively be accounted for by the decline in interest rates. And so looking forward, interest payments as a share of the economy are expected to rise substantially. We see that in about 10 years or so, we'll be hitting this 3% benchmark again, at least given the projection of the CBO. And if history is any indication of what will happen, it's at that point that we'll begin taking serious fiscal austerity measures. Hopefully we do it sooner, but again, if history is any indication, it won't be any later. And I think this will be the concluding graph here, and I'll show you that 3% in terms of other budget items is just enormous. So 3% on the expenditure side represents roughly the entire defense budget, almost all of Medicare, and about half of Social Security. And we could look at other budget items. Medicaid is about 2%, and a number of other programs could be financed with a reduction in interest payments relative to GDP. On the revenue side, you can eliminate the entire corporate income tax, at least, 1 or 2 times over, and eliminate, or you could eliminate the corporate income tax, the excise tax, and the tariffs, the estate and the gift tax. You could eliminate them all with 3%. 3% is about half of payroll tax revenue, so you could eliminate either the employer or the employee portion of Social Security taxes, and with all the money that 3% of GDP would comprise. And then finally, and maybe most surprisingly, we could reduce personal income taxes by 37% if we were to get rid of 3% interest payments on US government debt. So just an enormous amount. And that's why I think as we reach this 3% benchmark, that historical benchmark, that I think people will start taking a close look at policymakers that want to work to reduce government debt as opposed to increasing it. Okay, so thank you very much. I appreciate it. And at this point, I'd be happy to take any of your questions.
Okay, thanks so much, George. We have a few questions coming in. I think the biggest question is one that I know you've seen before, and it's about China, and it's that the Chinese purchase a large share of our debt. What happens if they stop lending to us?
Yeah, so this is a question that comes up a lot. I mean, we're potentially facing some political issues with China. There's always the question of what happens if China just closes the door on us, if they stop lending to us. They hold right now about maybe a little over $1 trillion of our debt. They're certainly somebody who we may, under normal circumstances, would like to continue relying on to finance our government debt, because by supplying us with that capital, we're able to finance our debt at a lower interest rate. And so if they slam the door on us, I don't think it would be the worst thing in the world. I don't think that we would have much of a problem finding other people to buy our debt. We wouldn't necessarily want to continue borrowing at the rate that we have been, but if they just slam the door on us and say, we're not buying any more of your debt, we've had it, I don't think that it would be that big of an impact because, and that's largely because of our demographic projections right now. If you look at how much savings has risen over the last several years and how much we anticipated to continue growing into the future, I think that projected capital supply will be enough to handle this, any single country from withdrawing from our debt sales.
Okay. From Nicholas Kurtenbach, we've got how do the recent, I don't understand this question, 2.3 trillion, and counting stimulus programs and expansion of federal balance impact the ongoing MMT debate?
Yeah, so I was worried that I would get an so MMT stands for modern monetary theory.
Thank you.
Yeah, it's no problem. But modern monetary theory, all that I have to say about modern monetary theory is that you hear from the time you're born, money doesn't grow on trees, but then it kind of does because the actual raw materials that they use to create currency might. But if you take that a little bit more seriously, we can't produce something out of nothing. Everything in the economy has to be financed. Everything, we can't just make stuff up. We can't just we can't just create something out of nothing. So with regards to modern monetary theory, I don't know that it's a theory that suggests that debt can continue growing inconsequentially because the Federal Reserve buys it, and so it's something having to do with a significant amount of inflation, and that we can somehow kind of wish our debt away. But I think the reality is that there are other factors in the market, in particular this surge in U.S. savings and capital supply, that is making debt growth a lot less consequential than we might have anticipated. And I think that's actually what's driving what we're seeing right now. And by the way, I wanted to thank Nick for the great quote on debt fatigue. He was our roundtable member that gave me that soundbite. So thank you, Nick, for the question, and thank you for the quote.
Okay, thanks. Is there anything else you want to say about the coronavirus stimulus package and its effects on the economy?
Yeah, so I think that we'll be able to absorb the increase in stimulus financing. I think that certainly there's going to be a sharp increase. I think that the increase is expected to add maybe 10 percentage points of GDP at a minimum to our current stock of debt. Interest rates are extremely low right now. We have a number of people who are looking to invest in safer assets because they maybe sense a little bit of financial market instability. Those are all factors that contribute to our government being able to finance this current stimulus package. But I would like to say just one thing about that. Over the next several weeks and months and maybe years, we'll be sort of sifting through the rubble to find out what the economic costs are of this COVID-19 pandemic. And one point with regards to government debt growth is that we're taking this huge stock of fiscal stimulus, this huge financial resource from other maybe future taxpayers. We're borrowing at a significant rate. And so it's not that maybe borrowing is going to cause adverse outcomes in the economy. It's the fact that we'll eventually need to pay this back. Debt doesn't just like I said before, we can't just wish debt away. We can't just magically get things to appear. We're going to have to pay this debt off at some point. And so when we do pay that debt off, we'll have to levy taxes or significant expenditure cuts. We don't really want to do either. And there are going to be some painful decisions in the future, and these decisions that we make, whether it's expenditure cuts or if we have to levy taxes to finance this, those taxes come with their own set of costs. So when we have to levy taxes on corporations, that influences the way that they make decisions. If we levy taxes on people's income, that can discourage people from earning income. So these are sort of the hidden costs, I think, of financing of this pandemic. And when we assess the economic damage corresponding to the COVID-19 pandemic and the quarantine, when we're weighing the costs and benefits, we should include these projected tax increases and expenditure cuts that we'll need to finance the stimulus when we think about the costs.
So these two questions are related to what you're saying. Michael Zilka says, does it matter to interest rates that the distribution of US wealth to GDP is increasingly unevenly distributed? And David Newberger says, your analysis is very interesting, but hasn't the growth in household net worth been concentrated on the top 1 to 5% of the economy? If tax programs and other programs were implemented such that this household capital was shared, wouldn't your analysis indicate that such a change be possible? Aren't there interesting tax opportunities? In fact, when taxes have been raised, the economy hasn't suffered.
Yeah, so that's a lot of points. There's a distributional impact, no doubt about it. Wealth concentration has changed over time. That's established. It's known that wealth, especially at the high end of the distribution, has changed and continued accumulating. So what I was talking about when I was talking about net worth was the impact on interest rates. And so for understanding interest rates, the relevant macroeconomic variable is aggregate wealth. So the distributional impact is important, no doubt about it. And I'll address that for a second, but I just wanted to make clear that when we're talking about the determination of interest rates, it's the aggregate savings that impact interest rates. Okay, so to the distributional side and to the implications and the tax or economic policy solutions to this. Okay, so large concentration of wealth at the high end. So we can talk about what policies there are that might begin to offset this concentration of wealth at the top. And that's actually been an area of research for me personally and for my co-authors. And what we find is that when we have policies that encourage savings at the low end, that they do have an impact. So the question is, how can we take this knowledge and apply it to tax policy? And in particular, I think a lot about corporate tax policy and really any policy that affects household savings and the taxation of that wealth after it leaves our hands. Okay, so let's think about that. When we're taxed, when our capital is taxed, it happens in a number of different ways. We pay dividend taxes, we pay taxes on interest, we pay taxes on capital gains, and that's only after we pay taxes on, if we own shares of corporations, then we pay corporate income taxes as well. So one of the big potential policy solutions, and not that it's a perfect solution, but one that a lot of people should be thinking about, and actually one that surprisingly Democrats and Republicans actually agree on, is this concept of corporate tax integration. And what corporate tax integration suggests is that we face this double taxation of capital income, right? So it's when we invest in a company, profits are taxed once at the corporate level, and then it's taxed again at the household level. Okay, so if Warren Buffett and I both own a share of the same company, we're paying the exact same marginal tax rate on every dollar of profit earned by that company. Okay, so Should we be paying the same marginal tax rate? Well, maybe that's a little bit subjective, but think about the following situation. Okay, so suppose that we were able to take that corporate tax paid at the firm level, levy it at the household level, so that we could then institute a progressive tax on all of that capital income. So as it turns out, this is one of the policy solutions that could play a significant role in reducing wealth inequality. And by that, I mean that households with lower income would pay a lower marginal tax rate on that corporate income, and wealthier households would pay a higher marginal tax. So that's kind of a optimistic outlook on the possibility that corporate tax policy and capital tax policy more generally could lead to some reductions in wealth inequality.
Okay, and there were a couple of questions early on regarding your slides about the birth rate. Stephanie Rudd says birth rate declining, but those that are born live longer. So what's the net impact? I think you ended up addressing some of that. And then Jim Tucker says, are the birth and aging rates on the two graphs global or for the US only?
Okay, so those are values for the US. If I remember correctly, they're both provided by the US Census Bureau. But again, we see this happening across most OECD countries, a decline in the birth rate. And U.S. went through a baby boom. Other countries went through a baby boom as well. You can look at survival probabilities; those have been increasing throughout the world. That's kind of a great outcome. The net impact. So something that people ask every once in a while is, okay, you showed us this graph of increasing savings throughout the life cycle, and then it declines later on. Could we eventually have such an upward shift in the age distribution that aggregate capital actually starts to decline because we start getting on the back end of that life cycle savings profile? Not under current projections. Under current projections, we'll still have a large share of households that are close to the peak of retirement. We can expect savings to continue growing over time, and at least under current projections over the next, say 100 years or so, we should expect that to continue. We should expect savings to continue growing as opposed to declining relative to the size of the economy. Hey, Morgan, sorry.
I'm sorry, I was muted. Susan Fikert says, to pay down the debt instead of raising the income tax, would a 1 cent national sales tax be worth looking at? Also with the caveat that when the debt is paid down, the national sales tax quietly goes away.
Yeah, so this concept of a national sales tax. Okay, so this gets into a few issues. One is federalism, and one is international taxation. So we could institute a 1% sales tax or consumption tax at the federal level. Certainly any additional revenue would pay down the debt, and we usually think of consumption taxes as having less distortionary impacts on economic behavior. And so a little bit of a problem is that you have these distributional impacts. We usually think of consumption taxes as being more regressive than other taxes, but I'd like to clear something up, that consumption taxes don't necessarily have to be regressive. If you look at what we have here in Texas, we have a heavy reliance on sales tax to finance government expenditures, and when you look at the sales tax base, we take a lot of regressive items out of it. We take, groceries, for example. You can look at a number of things, and that's true across all states. We tend to take things that if you're lower income and it comprises a relatively larger share of your expenditures, sometimes we take these things out. So with regards to a national sales tax, it's certainly not a bad idea. It's certainly something that we could implement in a way that satisfies other, subjective goals of progressivity, if that's what would be desirable. But I'd also like to say that in some sense, we do already levy some taxes on certain consumption goods. Like, for example, think about tariffs. So when there's been this big tariff war, right? China's selling goods to the United States, and so when they come to the United States, we levy a tax on it. So when we levy that tax, that tariff, it shares some properties of with other types of consumption taxes, like sales taxes or other excise taxes. So excise taxes are also levied. That's a type of consumption tax. So yeah, so to answer the question, and sorry, let me go back for a second to this federalism issue. So the U.S. federal government likes to reserve certain tax bases for state municipal governments. The sales tax I've always thought of as being one of those that it leaves almost exclusively. Property tax is another one. These are things that the federal government usually keeps their hands off of so that state municipal governments can use it to finance their expenditures. But it's certainly an interesting idea, and certainly any additional tax revenue would help us pay off our current stock of debt.
Okay. And David Newberger has a follow-up. He says, let's ask the question another way. He's pushing you here. It almost feels like we're in person with you, David. With this concentration of capital, doesn't this allow a redistribution of that capital so that it can fund a better healthcare system and better education systems? These funds would come from higher taxes, such as eliminating the differences in taxing income and capital, higher FICA taxes, changes in estate taxes, and the wealthy. I agree that companies should be allowed to deduct dividends from their income rather than debt.
Okay, that's a lot of different taxes. So that gets into the issue of benefits that are tied to specific taxes. Yeah, there are a number of taxes that we raise to finance very specific items, like Social Security taxes. We raise to finance our Social Security program. We raise Medicare taxes to finance our Medicare program. Same for unemployment insurance, and maybe at state municipal levels, we raise taxes, on property to finance schools. And yeah, so there are a number of different taxes that are tied to the benefit or to the expenditure. Certainly, we could raise taxes to finance an increase in healthcare. That could come from a number of different sources. I think it sounds to me like the point is that we might be able to reduce overall inequality by tying some of these taxes to their core, to some corresponding expenditure. Like, for example, if we have a lot of wealth concentration, maybe we could levy a wealth tax to finance something that helps low-income households more than high-income households, and something like that would be healthcare. There are a number of ways that we could use the tax system as well as the benefits to reduce sort of after tax and after benefit inequality. And I think you touched on a few. It certainly is up to the voters on that one.
Right. Okay. Well, I think we're ready to wrap up. Everyone out there, thank you so much for your excellent questions, and thank you for supporting the Baker Institute through your membership. And thanks to the staff at the Baker Institute for making this webinar happen today. And I'll send it over to you, Dr. Barro, for the last word.
All right. Well, thank you, Morgan. Thanks to you and to all the Baker Institute staff. That is, the work that you've done to help us continue our outreach has been amazing. Thank you to any of our roundtable members that chimed in with a question, and please be sure to continue staying engaged. Please feel free to reach out to me if you wanted to ask any other questions. If you would like, check out some of our research on the Baker Institute website. And please continue to check our Baker Institute website for other upcoming seminars and webinars and some of our research. So thanks again, everybody. Thank you for tuning in, and we hope to hear from you. Stay safe.
Thanks a lot. Bye-bye.